Ladies and gentlemen, good afternoon. How are you guys? How's the food? A hand of applause, a round of applause for the caterer, I suppose, right? My name is Susheel Kumar. I'm a public information officer for the Office of Disaster Recovery and Resilience. It's a real distinct pleasure to be here in front of this august group of people. Thank you, Governor's Office. Thank you, Houston District Office. Of course, Galveston College, and of course, the SBDCs, and so many people to thank. The reason why I'm here is to address what specific topics do business owners, homeowners and renters, and private nonprofits do after a storm. And I use the word homeowners and renters as part of my presentation, along with the word business. We are the largest source of funds for privately damaged properties post-disaster, the SBA it is. And 80% of my loans are to homeowners and renters. So for you folks who may not have been impacted from Hurricane Beryl or the derecho storms that came through in the month of April, please make sure that you advocate our program to the folks who were impacted. I'll make my comments very specific to Hurricane Beryl also, because Hurricane Beryl, on the heels of the derecho winds and the storm in the month of April, compounded the problem that business owners are facing as we speak, which is called economic injury. Businesses, hospitality, tourism, all have taken a dive. Not to talk about the homeowners and renters that were displaced, have to live somewhere else. I was in Dallas a couple of days ago attending to the needs of Dallas County and North Texas, that whole area, for the derecho winds. And when I was on the phone talking to folks from Dallas down south, in my 15-year career, I've seldom ever sensed a sense of futility, desperation, anxiety, for not only their paycheck, but for things to come. As you folks might know, Hurricane Beryl was the first Category 5 storm that came ashore this early in the hurricane season. And we've got till November 30th to navigate. So who we are, largest source of funds for privately damaged properties post-disaster. This is my bread and butter slide. What I mean by that is, you'll see the types of loans we offer, the type of borrowers we target or we respond to, the purpose behind it, and the maximum amount of money that can be lent to each entity type. You see homeowners there for $500,000. You see renters and homeowners for personal property, including automobiles, up to $100,000. And you've got economic injury, which is a combination, when that loan amount is a combination of physical damages, where the property is actually destroyed, and the part where they're not necessarily destroyed, and, thank you sir, sorry about that, where the part is they haven't opened and they can't sell. We were chronicled, my boss was in town yesterday as part of our Business Recovery Center opening, and we spoke with a local restaurant owner who was there. I'll be talking with him after this particular event to discuss what he and she and other business owners can do to get back to being thriving. We offer low interest rate to all businesses of all sizes. Nonprofits include EDCs, economic development companies, corporations, agencies, chambers of commerce, and other 501c3. What do? We're going through a tremendous transformation from years past. And there is a phrase in paragraph number 2 that my boss coined, lend and leave model to whole of SBA enterprise. What does that mean for the rest of us? We were primarily a lender that came in, assisted our constituents and stakeholders, instead of being part of a community-based recovery. If you also noticed, this number right here, over the past 4 years. What does that say to all of us? That not only are these weather disruptions happening frequently, they're also happening at an increasingly alarming financial cost to all of us. $6.5 billion. The last billion-dollar disaster that I recall back in the earlier days of my career started with the SBA in 2012 with Hurricane Sandy. That was a billion-dollar disaster. There weren't a lot till about 2017 till Harvey hit. I was working in the Beaumont Golden Triangle area, and I recall saying to myself, billion-dollar disasters, here we go. $6.5 billion. So one of my messages today is on the response side, what you folks can do, advocate for, apply for, to make the economy more resilient. One of my agency's charter is to maintain the tax base. As a result, make sure that there's no unmet needs. What do I mean by that? After a disaster, what a lot of times happens is aggregate spending goes out the window. By the way, great job on the panel earlier today. I'm a former banker for 29 years. My last gig was SVP, and I heard a lot of different things about what relationships to build and some of your answers and all that stuff, so great job. Good job, Elizabeth Charles, where are you? Wherever you are, good job for you. Having said that, I lost my train of thought while I was complimenting you, right? That's what you call a senior moment, for God's sakes. So let me come back to my thought process, Jennifer, you're trouble. We have loan limits up to $500,000 for real estate, repair and replacement, and I'll talk about refinancing and mitigation in a second. Those numbers were recently improved as of August 1st of last year, thanks to the leadership of my administrator, Isabel Guzman, and my boss, Francisco Sanchez. Loan limits for personal property, including automobiles, went from $40,000 to $100,000. And here's the biggest takeaway. There is a deferment period for 12 months with no interest accrued for all disaster loans. So if you were to borrow money from me today, you don't make a payment for a year after your first round of disbursement. And all these loans are like construction loans. In other words, it's percentage of work completed. So if Amy is my customer and I'm the contractor, she and I will have a scope of work to be done, and then an SB inspector comes out to check it out, and then they disperse those funds. What that does is ensure that the work was done so that there is no question asked about it at a later time, right? So not all $500,000 is put into Amy's account, and then she's like, I don't know what I did with it. So it's done as a percentage of completion. You'd be surprised how many different individuals over my lifetime, even with the small sums of money. So for example, there is a program that FEMA offers where they'll front SBA or front the applicant money to do housing repairs with the anticipation that the SBA loan will pay them back. FEMA's role in a disaster is very specifically to return the applicant to a safe, secure, sanitary condition. That's it. Their maximum grant amount is about $42,000. So when you talk to people and they are expecting FEMA to be the be-all and the end-all, would you please help me manage those expectations by saying, talk to the SBA, because they are the largest source of funds, because we don't want folks to be sent over here and then be, oh, they don't do that, well, come over here. So that little step for a disaster applicant, it might seem trivial, but when they're going through the shock and awe of recovering from such an incredible journey, why would you send them the wrong way? Secondly, FEMA does not have a lending program in the individual assistance space. Let me throw another piece of information out there for all of us. The federal partners who are here were requested by the governor's office, Governor Abbott, when they ask us, according to the Stafford Act, will you please send federal dollars in to meet the needs of the local folks, because the capacity of Texas, the state of Texas in this case, clearly outweighs the resource that Texas has, clearly outweighs the recovery dollars and cents needed. Will you please bring FEMA and SBA in? So we're here at the request of the governor's office. Thank you, Jarvis, and thank you, Madam Cruz. Mitigation disaster loans. Prior to the changeover as of last August, you could only mitigate against the event that caused the damages. So if your damages was caused by a flooding event, that's all you could mitigate against. But now that change has moved over to all perils. When was the last time that you recall, prior to the most recent activities, I'm going to make sure I don't walk forward, that'd be a disaster. When you heard of a tornado in Houston, last year in Pasadena, right? And right after that, right before that, somewhere, all the disasters are running together in my head right now. New Orleans had a tornado in 2017, and they had one going through the same area last March or the year before. Tornadoes in New Orleans? The Hurricane Alley, or in this case, Tornado Alley, was very specifically Dallas up into Oklahoma and into Arkansas, into Missouri, and further up. It's shifted downward. So to have a mitigation loan that takes care of us here for an event that we never had before is a wise move. United Lending Platform. It's a new platform that we started and was really based on the fact that it was taken us 100 days to process and fund loans. Now on average, if you apply with us, we have a complete package. The funds are in your bank account within 30 days. Huge change. And it's welcome because the folks who are waiting for the money can't wait 100 days. Here's my interest rate. 2.68% fixed for a 30-year term. Businesses as low as 4%. Nonprofits 3.25%. All over amortized over maximum 30-year term. All the bankers on the platform here a little while ago will agree that their cost of funds is higher than that. Let me give you another example. If you were to borrow money from a bank, it's Prime Plus. In my days, Prime Credit were absent. Those were basically meant for municipalities. Prime right now is about 8.25%, 8.5%. They're usually Prime Plus, right, Ms. Petrie? Yes. So when we're talking about Prime Plus, you're sometimes talking about double digits. So if your cost of doing business is in double digits and we're lending you money at 4% fixed, the incentive to borrow no longer, it's quite high, and the impediments no longer exist. The average mortgage loan, if you were to go to a mortgage lender, somewhere in the mid-6s, mid-7s perhaps, somewhere between 6.15 and 7.15, we're at 2.68%. And if you remember the language that you saw in the previous slide, we talked about refinancing. So here's how that works in a very narrow sense. If your home is substantially damaged, you plan on staying in the property, you're going to repair it, and we lend you the funds, and like we took Amy's example, after Amy's used all of my money, SBA's money, if it makes sense, we can refinance the first and make it into one loan at 2.68%. Banks don't have space to loan money on impaired assets, period. They just don't. Neither do credit unions, neither do CDFIs, and all the lenders in the world. We are a niche lender, cash flow lender, exactly for that purposes. Now, businesses I started off talking about, the cost of borrowing, folks, for the federal government as of this morning, based on the 10-year Treasury or the 30-year Treasury, was anywhere between 4.12 to 4.22%. That's the cost of borrowing for the federal government. Look what we have for local businesses. Isn't that an incentive to borrow? And here we are. Here's the other part, 30-year term, maximum. So we're a cash flow lender. We want folks to borrow money. We want folks to get back on their feet because that revenue source is absolutely incredibly important. And so that I don't make you guys have indigestion, let me share a statistic with you very lightly, but please do take it seriously. 1 in 5 businesses that stay closed for the first 5 days of a natural disaster have a 90% failure rate at the end of the first year. There have been studies done by Temple University that talked about borrowing from the SBA, and those borrowings kept 83% of all businesses that applied had a multiple percentage growth the following years. We realize as a society that borrowing is not necessarily good for all of us, but it does give you the leveraging effect that's most importantly needed. And that's where we come into play. Who's eligible? Those are my constituents. That's my job. So as I've talked to various people here, thank you, Christine Bryant. I didn't get a chance to thank her. And Ms. Meet Pena, and of course, Dr. Miles Shelton. Whoever you talk to, please make sure that they know, renters, homeowners, private nonprofits, and businesses. I'd like to hold town halls with you folks so that I'm able to get this message to the lowest common denominator in the aggregation, right? These are the primary Texas counties as of July 17 that were affected. And the difference between the two, between primary and economic injury, is these counties can only apply for loss of revenue. That's what's happening on the island, all right? They're up here, Galveston up there. I keep pressing the wrong button. Sorry about that, guys. It's just fat fingers, you know? Galveston. They can apply for both. So if a business in Waller is counting on money coming from Galveston, and Galveston can't send the money out, you got economic injury. The other definition of economic injury is the inability to make your payments that you normally would have been able to prior to the disaster. That's pretty much the very overarching example of an economic injury. Getting down to financial terms. Businesses are in place to make money, period. And how do you measure it? On your income statement, you have a line item called net profit. That net profit flows into your balance sheet. It becomes part of your retained earnings. And if you don't make money, you can't be in business for a long period of time, right? So ultimately, we are able to lend money when that net profit deteriorates, the margins deteriorate. The slimming of those margins is considered economic injury. And how are we able to lend money is based on lending that damages amount. So let's say you're 15% margins, and now you're down to 2%. That 13% margin that you have delineated over a 30-year term at a 4% interest rate, are you able to pay that back? If the answer is yes, for the most part, the loan is yours. That's simply the calculus of it all. And folks here are counting on their bread and butter to come in, but it's not coming in. So how do you get that bread and butter going? Borrow money from us. It's that simple. What can the money be used for? Obviously, repair and replace. Have you folks heard of any insurance company that makes you whole dollar for dollar? What do they call the difference between what they give you? Well, yeah. The reason they have a profit is because they don't pay out the claims, true. But if you get 70 cents on the dollar, and that 30 cents is defined as what? Anybody? It's called depreciation and deductibles. We will cover those. FEMA can't. FEMA won't. Right? So when you get a percentage of the whole amount, the remaining portion, we can cover that. Okay? And we talked about relocation. We talked about refinance on a case-by-case basis. Relocation. If somebody wants to move from one side of the street in Galveston to, move from 39th Street down to 21st Street, that's okay. But if I want to pick up and go to Hollywood and say, I've always wanted to live in Hollywood, I got money from the U.S. Treasury, that's a no-no. Because it's not about relocating to your place of choice. It's about relocating to maintain the tax base of Galveston County. Business loans, same thing. Real estate, inventory, machinery. Think of me as your Federal Reserve bank that lends money under extreme austere conditions. And that's why we're able to lend money at such a low price for the aggregate whole. Debris removal. I was talking to a few folks yesterday in Harris County. Their damages were that the trees fell on their home and on their cars. Can you help pay for the cost of debris removal? The answer is yes. Operating expenses. Could be your insurance payment. could be a current year tax payment. It could be bank debt. Did you know, Jennifer, that if your customers have not paid you because they're suffering through this, I can help you shore up your balance sheet? In other words, payments that are due to a bank or some sort of captive finance company for fixed assets, those payments could be made from our loan proceeds. And what does that do for her portfolio? Maintains it in a performing status. Because after 90 days, they have to prepare some reports that state that there are certain percentage of their assets are non-performing. So what are we doing? Making sure that the tax base is maintained as a wholesome part. Accounts payable, mortgage payments, rent payments, monthly lease obligations. We talked about this a little while ago, where all perils, wind, flood, wildfire, and earthquake. I'll give you a small example. I live in California. Please don't boo me. That's home, but I'm never home. 9 months out of the year, I'm traveling for various disasters. I looked up my insurance quote for earthquakes. And living in Sacramento, people don't think about us being in earthquake territory. They think of the coastline, San Francisco, Los Angeles, San Diego, Carmel, Monterey, things along those lines, right? In Sacramento, we have a 76% probability of an earthquake in the next 5 years. Dug a little further. On a hypothetical claim on homes with 1.5% deductible, and homes in California, as I'm sure, are very pricey for obvious reasons. Land is expensive and people go this way instead of this way. Today, the premium is $203. After your first claim post-disaster, that number jumps to $4,000. Some insurance companies are pulling out of California, then they made the decision to come back in. State Farm, to be example. So these types of perils and mitigation are quite important. The cost of rebuilding has been demonstrably low if you use certain types of materials. So when you folks think of building back better, please take a look at the insurance business of highway safety. They've got all kinds of ways that you can rebuild better. This is my portal, lending.sba.gov. All the documents that you need to be familiar with before you apply for the disaster is on there, okay? Step 2, once you apply with us, we have a business recovery center on Market Street that opened up yesterday. We will send out an appraiser. And using Amy as an example, Amy applies, we send an appraiser out for Amy's property, and we take stock of what damages her home has suffered, along with the personal property. That specific inventory of her losses is her loan amount. Unlike mortgage lending, where somebody is pre-approved based on your income, and they say 4 times income, 5 times income. On business side, it's a multiple of EBITDA, so on and so forth, right? Was that impressive in EBITDA? Good God. I usually stammer over that. A little bit of levity in a foreign topic, right? We will take a stock of your losses, that's your loan amount, and then the next hard part is to figure out whether they can repay the loan. We don't duplicate insurance benefits. So, can the borrower repay, can Amy repay at 2.68% on a hypothetical $100,000 damage over a 30-year term? If the answer is yes, and she pays her bills on time, for the most part, the money is hers. What we take a look at, I think in the previous discussion, we talked about delinquency. That's a no-no. Federal and state taxes being tardy, that's a no-no. Back child support, that's a no-no. Debt to income being high, that's a no-no. Because it's not, as people say, SBA gives you money. No, no, no. You earned it, and we're making sure that you folks are responsible enough to repayment. Somebody mentioned 5 C's of credit, right? There's also the 363 rule in banking, which I never faced. You know what the 363 rule is in banking is? Anybody? 363 rule in banking, anybody? So when I was graduating Tulane back in 1986, I was looking forward to the 363 rule, and I never faced it. The comment was, you take deposits in at 3%, you lend at 6, and be in the golf course at 3 o'clock. And when I graduated college, I'm like, you're right on. But didn't happen, but didn't happen. So basically, bottom line is, can they repay it over a 30-year term. And as you see on step number 3, the money's in your bank account fairly quickly. Please make sure that when you advocate for our program, and if you get into the weeds with them, some of you folks might, nobody wants to borrow money with a collateral against their home. But here is the flip side of that argument. If the person who's pledging collateral does not believe in their own recovery by refusing to pledge collateral, why would somebody else? So here's what happens, right? You have a nice car, let's call it a Porsche 911, right? You got a nice car, and your tires cost $5,000. I don't know if it does or not, but let's say each of the tires cost $5,000, those, ZR25s and blah, 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 and all those fancy stuff, right? Rated G or whatever the number is. Each of them costs $5,000, but you only want to spend $2,000 on that Porsche. What has happened to that Porsche? It's not going to handle as well. In the case of real estate, you've got the example of deferred maintenance. Suddenly you are not doing what the real estate needs. You've got a headache, you take ibuprofen, but that could be a sign of a heart attack. So don't be penny wise and pound foolish and only borrow the sums of money which are not secured. We've got folks like Brenda here that service the customers for all things SBA. You can drop off information, you can ask for information, you can answer all questions about the programs, and we're there 9 to 6 at 2121 Market Street. I'm your lead contact for Texas. My partner in crime, Elizabeth, who some of you saw yesterday, was there with me. She's out of Austin at the Joint Field Office. Sorry she couldn't be here. But with that, turn to questions.
What's the most common loan today?
80% of my loans are to homeowners and renters. And what I'm hoping to see with your advocacy and with your energy in the room is to talk to every business owner that's part of the tax base of Galveston County. Hotels, motels, restaurants, things along those lines, who are trying to make a dollar and get the foot traffic going so that the tax base is not impeded materially. It may already have. In speaking with various folks at Entergy, a little further up in Liberty County, they had a presentation that I attended, and I was a speaker right after that. They had a slide that demonstrated the average turnaround for Entergy companies or Entergy customers was 7 days. I'll give you another insidious example. Working in New Orleans for Hurricane Ida. Businesses that closed during Ida, as of last 2 months ago when I was there for another declaration, had not reopened. There are businesses up and down St. Charles Avenue, which is pretty much Mardi Gras Central. That's where the floats go through. There are businesses that had not reopened. The question was, if I have an existing COVID economic injury disaster loans, can I apply for another? The answer is yes, sir. We are a cash flow lender. We don't have the statutory authority to combine them yet, and so it stands alone. It's basically a cash flow scenario. Yes, sir.
So if we have some additional storms come through later this summer or going into September, August, you're saying we can apply multiple times if there's damage that occurs each time?
If I understood you correctly, if there's additional damages that did not happen during this time frame, you can't reapply. So your initial damages had to be through 5th of July through the 9th of July.
You're saying if there's another storm that happens?
Of course. Of course. Of course, yes, sir. I saw a hand up here somewhere too. Sir.
Can a business use this to buy a commercial property that was damaged by the storm if it's not their current operation or location?
Repeat the question for me.
Can a business buy a commercial property with this loan that was damaged by the storm if it's not their existing structure?
No, sir. You would have to talk to Elizabeth Charles and Valerie Marr and Mr. Winchester for a regular commercial real estate loan to purchase that property. And chances are they won't want our loan to be there first because you have a property that's in distress, so they won't have the best use and the income and everything else that comes with it. So they're not going to necessarily cash flow. So wait for it to normalize, as we call it, and then buy the property. Yes,
We
sir.
have time for one more question.
Okay. Sir.
So for most of us, this issue had been a lack of electricity for a week and a half. Can the loan be used for purchasing commercial generators for businesses that need to remain open for essential workers? So like child care centers and other programs like that. Can you use the loan to purchase something like that to fortify your place for the next?
Requested specifically under mitigation. So that 20% number that I talked to you about, please make sure that you are very specific that you're using mitigation money to buy generators to stay in operation to mitigate the cost of doing future business. Thank you, folks. Appreciate it.
Thank you, Mr. Kumar, for your information. Will you be around for a little bit?